Well, good morning, everyone. Today is March 26th. It's a Thursday, and what do I always say? Let's get into it. All right, we had unemployment numbers, folks. 3.3 million Americans applied for unemployment benefits last week, more than quadruple the previous record set in 1982. The surge in weekly unemployment was a stunning reflection of the damage of the viral outbreak is doing to the economy. As job losses mount, some economists say the nation's unemployment rate could approach 13% by May. In comparison, the highest jobless rate in Great Recession ended in 2009 was 10%. In more news, Goldman sees U.S. oil prices well below $20. This is why I'm not in a rush to buy oil. Fed Powell says the Fed will provide literally unlimited lending. Restaurant growth coming to a screeching halt. Cheesecake Factory can't pay its April mortgage. Japan to impose entry bans for Europe, which may not be the worst idea in the world in light of what's going on right now. And who is it? I think a luxury store is filing for bankruptcy. I'm not sure who it is. It's either Nordstrom's or somebody similar to Nordstrom's, but it's a very high-end store. It's also going through bankruptcy or announced bankruptcy yesterday. And we're going to be seeing a lot more of it. Now, looking at the news, you will see that today we had the GDP report, which, let me just give you the numbers here, actually was in line, which isn't that bad. But remember, that takes in the quarter, the full quarter. Tomorrow, the most important report, in my opinion, is not going to be the personal income. We already know that's going to be offset because we know the jobless claim is so bad. 4 times worse than the worst number. I mean, it's terrible. But the number I'm looking for is the consumer sentiment, because this consumer sentiment level is going to take into account potentially what investors are seeing in the market. This will take most of it into account. It'll be very, very interesting to see what happens. Now, some of you may be thinking, hey, Roger, we've had, and I'm sure a lot of you are asking, hey, we just had a stimulus. Why did the market rally before that? And as soon as it was announced, the market didn't do anything. I mean, this is before and this is after. The truth of the matter is most news, most positive and negative news gets baked into the market before the news occurs. And then the only real question becomes, is the announcement better than the expectation or worse? That's how you have to look at it. For example, this economic data, you see the consumer sentiment consensus. This 92 number is priced into the market before the report comes out. Those are the sentiments. So if the number is better than 92, the market will rally. If it's worse than 92, the market will go down. Doesn't mean 92 is a good number or a bad number. It's just based on the expectation, and that's what the market's going to bake into its price. Very important to understand that, okay? Very important. The market doesn't move based on what happens. The market moves based on what we think is going to happen. And the consensus is obviously what we think is going to happen. So always compare the actual number to the consensus and see if that number is better or worse. If it's better than the consensus, then it's positive for the market. If it's worse than the consensus, then it's negative for the market. But always look at the expectations, not the actual number. It doesn't matter if the actual number is good or bad. It's what the expectations is. And this was a very good example of showing you that, because when we were expecting the Fed, the government to give aid, the market rallied. We had the 2 biggest days in history. If you look at these 2 days together, it had the 2 biggest days in history. And once the numbers came out, this is all we saw. And now that the numbers are out, the market is lower again. And even yesterday, it was struggling to maintain a healthy tone. So again, always look, especially in this market, look at the expectations. Neiman Marcus, that's the store. Neiman Marcus filed for bankruptcy. Not Nordstrom's. Excuse me. Neiman. I always confuse Neiman Marcus and Nordstrom's. Don't tell my wife. She'll be very upset. Those are her 2 favorite stores. And Saks, Fifth Avenue, whatever those stores are called. I'm not a big shopper, but my wife is. But I always get confused between Nordstrom's and Neiman Marcus. What can I do? Anyhow, Oil prices. Goldman Sachs came out and says, hey, we're not expecting oil prices to be above 20 for a while. That's weighting in on the oil price market. Oil is down almost 4%. Notice that, and this is something you want to pay attention. This is a very important technical factor. When you see a market go down and reach an all-time low, you want to see how far it bounces off. Usually, if the selling is overdone, the bounce will be very, very fast, very, very quick. Let me show you an example. Let me show you a really good example of this. Right here. Let me go back to continuous data. Let's see if I could show you this right here. There we go. See that? The market goes down and then just bounces back really quick. That's telling us that this reaction was overdone. Here, we still have time to come back up, but I'm not seeing it on the S&P. This is the S&P. I'm going back and forth between bonds and S&P to show you the point I was making. Notice there's a question mark of whether we're going to be bouncing back here or not. We've been down here for a few days now, and the rally seems to be fizzling out. If you look at the crude oil market, notice this is a daily chart. You want to use daily data for this. Notice we bounced down, we made a low at about 20, but notice this trading action over the last few days, it hasn't really gone up. There hasn't been any real major rush to get into the oil market. Technically, that's a failure. That's not a positive fact. If this was overdone, we would see oil come up right here to the 37 level and fill the gap over the last few days, or at least try to. And we haven't seen any of that. We've literally been sitting on the lows, and that's not positive. Bond market. Bond market went up when the stock market originally broke, but then as the stock market kept going down, the bond market went down too. That happened because the government promised to give aid, and the Fed brought in liquidity into the bond market. And when you put a lot of liquidity into the bond market, that liquidity softens prices. Notice if you have an asset that has very low liquidity, very low open interest, very low volume, it tends to have very quick jagged moves. But when you bring liquidity into the market, when there's a lot of liquidity, the buying and selling softens up. So that has been absorbed, and now the bond market appears to be moving back in line with the S&P. When I say in line, I mean inverse. Typically, when stocks go up, bonds go down. When bonds go down, stocks go up. Now we're seeing stocks soften up, and we're seeing bonds rally again. So I'm anticipating from this point on, unless the Fed decides to put more money into the bond market, and I don't think they're doing that right now at this time, I believe we're going to see more upside in the bond market. Another reason why bonds sold off is because this downside, this correction, this coronavirus pandemic can potentially be so deadly that a lot of investors don't want to put their money in the bond market. They want to keep their money in cash or put their money in the US dollar, which is why the US dollar has been moving up so much. As a matter of fact, let me show you what I'm talking about. Let me show you indices here. You will see that as soon as the market sold off, where are my indices? Where's my financials? Currencies, here we go. I'm all over the place today. As usual, if you look at the US dollar, you will see that it went up really, really hard. Notice that? And then as soon as the Fed announced they're going to help out the economy more, the dollar, excuse me, I'm going back and forth between oil, dollar, and the US market. The dollar started moving down, and money started coming back into the bond market, which we had here. Actually, you know what? Let me compare the two so you could see them next to each other. That's the US dollar, and here you will see the bond market. Notice initially money went into the bond market, then the bond market sold off when the Fed announced a lot of money going into the bond market, and now it's coming back. Meanwhile, the US dollar rallied, and then as soon as the Fed announced they're going to save the day, the dollar went out. People started feeling a little more warm and fuzzy about fixed income and started putting their money back into the bond market. And I'm expecting that to continue moving higher if the E-mini S&P continues moving lower. Now, here's the deal with the S&P 500. If we don't get a rally over the next few days, if we don't break the 2590 level over the next few days, the odds are we're going to go back down. We're going to go in for another count. A lot of professional traders believe that's the case, including me. Why? Because I don't think the worst is behind us. We don't know how many people are going to be infected in the U.S. We don't know how many hospital beds we're going to get in New York. If the numbers are going to be better than expected, the markets will start rallying ahead of that. But right now, it's a big question mark. No one knows anything. But what I can tell you is I'm expecting this drama to continue for some time. Again, the S&P level, the E-mini S&P level is about 2570. Let me give it to you on the Dow Jones so you have the same power. Now, the market's not opening for another half hour. Notice I'm doing all of this analysis before the opening bell. That level on the Dow Jones is 22,000. You got to watch out for 22,000. See if we can break the 22,000 level on the Dow Jones. That's very important. I'm looking at the DIA Diamond, which is the ETF that tracks the Dow Jones, but it's exactly like the Dow Jones minus a zero in the end, or actually 2 zeros in the end. So this would be about 22,000 on the Dow Jones itself. Keep your eye out. If we break above 22,000, we're good. If we break below 18,000, we're very bad. Expect for the next day or two, unless something drastic happens, for price action to fluctuate between 21,500 and 18,000. Expect volatility to continue, but I do believe we are going to get some defensive play from the bond market, which we weren't getting. Now, as I said a minute ago, have you guys noticed everything I'm doing right now? I'm telling you what I'm expecting today and tomorrow. I'm looking at economic data. I'm looking at overnight data. I'm looking at futures data. This data is going to tell me what the market is going to do. Believe it or not, but overnight data, this data that I'm looking for, it's accurate in telling me what the market's going to do about 70 to 75% of the time. I'm not kidding. I'm not joking. So if you're looking at yesterday's data, folks, it'll bankrupt you. What I'm looking for is what happened overnight in the European market, in the Asian market, and in the night session market. And that's reflecting what happened in the daytime data. So if you're just looking at yesterday's data, it's like reading the first 2 chapters in a book and then skipping to chapter 10. You don't want to do that. You want to read every chapter so you can know exactly when you get to the end of the book what happened. So again, looking at yesterday's data will bankrupt you. You might look at markets when you go to bed, wake up in the morning with a completely different picture. Like today, for example, with the unemployment number coming out 4 times worse than the worst number in 82. If you used yesterday's data, you would know that and you wouldn't see how the futures are reacting to it right now. Markets are moving too fast. Yesterday might as well be a year ago. And I'm not kidding. For last night and this morning, it's like 2 different markets. We've already absorbed everything that happened overnight in Asia, in Europe. The market's now absorbing what happened with the employment report. All that happened between the time the market closed yesterday and right now. This is why I've teamed up with the world's #1 pre-market trader, Tom Busby. This guy is amazing, to show you how we cracked an all-new style of trading. We still trade during the trading session, during the day, but we analyze all our data before the market opens. Now, it allows us to spot potential winning trades before most traders even wake up. I'm not kidding you. Which, in today's market, could make all the difference in the world. If you like to see these trades in action, click on the link below, watch the presentation. You will be blown away. You will be blown away by what you see. Folks, again, think about this. Everything I've done right now, I've laid out today's trading session. I've laid out volatility levels on the SPY, what I'm expecting the bond to do. I showed you what reports matter, the numbers that matter. All of this was derived from data that happened between last night and this morning. This is what makes difference in trading. Now, I'm not going to trade before the market opens. I'm still going to trade after the market opens. But knowing this data, and this is just a taste. Tom and I, we go deep. We go really, really deep. And Tom is the best trader, the best pre-market analyst in the world. He's the number one world's pre-market trader. You don't want to miss this. It'll make, like what I'm showing you right now, it'll make a total sense. It'll put everything together for you. You'll know before the market opens where to buy, where to sell, where to put your stop loss, what to avoid. And some trades, you don't even have to manage. You could just walk away, enjoy your day, and have fun, come back, and then enjoy the profits. Tom made like 49% on a gold trade just the other day, while the S&P's tanking 30%. Folks, you don't want to miss this. Follow the link below. Check out this video. Check out this presentation Tom and I put together. You won't regret it. Folks, do it now. Talk soon. Have a great day.